Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 12th day of March, 2019. Well, we have a real jam-packed schedule today, so let's jump right into it, although I guess before we get started, we do have to thank our sponsors for making this show economically viable. Our sponsors for this week's show, Novo Resources, Triumph Gold, Gold Mining, Inc., Uranium Energy, Miramont Resources, Great Bear Resources, and Klondike Gold. I've titled today's show, Will America Face an Economic Recession in 2019? Danielle DiMartino-Booth, Michael Oliver, and Robert Moriarty are guests today. Danielle always provides insightful commentary on mainstream TV shows regarding the Federal Reserve and its monetary policy, especially around the times when key Fed rate decisions are being made. She worked as an advisor to Richard Fisher, a member of the Federal Reserve Board of Governors, during the massive unconventional monetary printing experiment following the 2008 financial crisis. Well, Fisher was always a critic of QE, and no doubt in my mind that Danielle, who has had an extensive experience on Wall Street before going to work with Mr. Fisher, no doubt had some insights into his insights, some influence into the insights that Fisher had. Her experience at the Fed provided great insights into how the Fed operates and what the driving forces behind the Fed are. So no wonder she is a much sought-after guest during key Fed rate changes. Danielle has picked up on the enormous damage that the Fed has heaped on the U.S. economy. She has written a book about it. In 2017, she wrote Fed Up, an insider's take on why the Federal Reserve is bad for America, not only in terms of impoverishing our country by denying our capital system price discovery of capital, but by enabling those in control of the monetary system to become extremely rich at the expense of the middle class. Well, I'm looking forward to talking to Danielle in the second half of today's show to learn what she expects in terms of the monetary policy going forward and whether she thinks we may be entering a recession in 2019. And right after our first commercial break in just a few minutes, Bob Moriarty will be with me to talk about three of his favorite stocks, which happen to be three of my top picks as well. Those three stocks are Novo Resources, Miramont Resources, and Irving Resources. Two of the three, of course, are sponsors of the show. What all three of these companies have in common is Dr. Quinton Henning, who is playing a major role in the exploration efforts of each of those companies. So I'm looking forward to talking to Bob about those three companies, and which I also own personally and have recommended in my newsletter. Bob is always an informative and entertaining guest, so I hope that you'll stick around for the second segment. But right now, I'm really happy to tell you that Michael Oliver is with me once again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
It is always good to have you here, and it's olivermsa.com, olivermsa.com. Well, gold has disappointed some of the bulls, although just before the show time here today, it started to rise upward. I think it's peaked through 1,300 again. But looking at your momentum charts, what are you looking at? What are you seeing? I mean, it's very interesting, Michael. What people are wetting their pants, the bulls are wetting their pants over the declining gold price. You're as calm as a cucumber. You don't seem to worry too much and weren't worrying too much. What are your thoughts about gold right now?
Well, we after the August low last year, which was a second pullback in the 3 or so year process of basing by gold after its 2015 low, we had all the upside shots went into the mid-1300s and got repelled there. And we dropped down to 1120 in December 2016, shot back up. We dropped to 1160 area in August last year and shot back up. The only difference was this time when we came back up almost unflinchingly. In other words, if you examine the rally, it advanced more rapidly without fanfare, but without any serious pullbacks at all to get back into the mid-1300s, whereas the other prior moves back up into the 1300s had some serious $100-plus pullbacks. We've had, so far, a $60 pullback. And we're back up now within $28 of getting back to the high again, or $30-some. Therefore, the tone of the market's different this time. The bidders are more aggressive. They don't wait for $100 pullback. They grab a $60, and next thing you know, you're 20 off the low. So I think there's a tonal difference just looking at the price charts. But from a momentum perspective, we're out above resistance. Price is the only remaining barrier. And it's this silly line that anybody can draw on. Go to Google Gold on a chart somewhere on the internet and draw a line across all the highs since 2014, and you'll see it comes through right now at about 1340.50 area. We recently got up to 1345, pull back, and now we're 1302.40 as we speak. So I think if you go back up to 1340 again, we're going to explode. I don't think that line deserves more than what it just got, namely a quick $60 pullback that took 2 weeks. You go back up there again, this time I think you go through that stuff and the price chart crowd will be activated. And that should unleash a torrent of money into this sector, not just gold itself, but into the gold miners in particular. And I think they will, as we've said all along, I think they'll outperform gold in the next up leg. But you still have to watch gold because it's the mama. But I think gold's in a great position. And I think while the miners will beat it, watch gold, and it looks like it's ripe to go back up. I'd say if you get in the mid-1300s again, don't be shocked if you see something in the 1500s within a month or so. Quite literally.
And your momentum work for GDX is looking solid as well, I think, right, to the upside.
Yeah, they ran up recently to 23.5 area on GDX. We turned bullish coming off the August lows at 20, just above 20. All our lights turned green at that point. And we're now toiling between 22, 23 area. And we hit 23.70, I think was the high tick a few weeks ago. Last week was a decent up week. We're gaining more today. If you ever touch 24, expect the lights there to turn green for the price chart crowd. Again, the only barriers remaining on gold and gold miners are price charts. Momentum is fully green-lighted. Price usually lags momentum, and we're pretty confident that price will follow suit and break through its obvious trend lines.
All right. I have to ask you about the equity market, the S&P 500. That has refused to go down. It's just like it's sort of the reversal of gold in many ways. I think, you're calling for a bear market in the S&P 500. I think you're calling for it. I think your momentum work is already suggesting we're in that bear market, right?
I think this rally is just a very impressive thin air rally. When we run our momentum charts, and even price to some extent, the rally was quite easy because there was nothing to stop it. In other words, you dropped so far below structural supports that when you turned and rallied, there was nothing to stop you. It was like a thin air, like a trampoline. So you're not breaking out of anything, you're just rallying in thin air. And if you will notice, we've actually stalled for the last month or so, either side of 2,800. So we're not gaining a lot of turf, we're just hanging in there. And we're about to run a report to our regular subscriber audience, all asset category subscriptions, on spread relationships within the S&P. In other words, what are the sectors doing? And they're doing the wrong thing if you're a bull. For instance, the tech sector broke its relative performance uptrend versus the S&P credibly late last year. The rally back up is not changing that trend. How come utilities are beating the S&P now? How come consumer staples, the toilet paper makers, how come they're beating the S&P on a relative performance basis? Why? Right. Because investor capital is moving into safe areas.
All right. With 1 minute left, I had a subscriber or a listener actually ask about the grains. He says in the grains it appears to have been more of a rally in a bear market than the start of a bull market, as such things as wheat are making new lows. Any comments on that?
No, first off, they're not making new lows. If you go back to 2014, after a major collapse from 2011 through 14 and 15, and all the grains, soybeans, corn, and wheat, they basically stopped going down in mid-2014. Wheat is now trading in the middle of the range that began in the middle of 2014. So is corn. Soybeans are slightly below the midpoint of that price range. Again, price levels that we saw in 2014, 15, 16, 17, 18, and now 19. Okay, so what you've got is horizontal action in the grains. We thought we had a breakout early last year, 2018. Then the Trump tariff wars came into play in spring, drove the soybeans down particularly hard. They actually made marginal new lows and have since gone up from those new lows, so they're back in the range. But grains are actually sideways. So the issue is for investors, you're looking at something, in our view, that's a value investment. it's going sideways. It will turn up. The issue is when. We thought we'd nailed it last year. It didn't turn out to be correct. They pulled back within the range. And now they're firming again. Wheat's up like 20 cents today. So we still think as an investment class place to look, food commodities are a place to look. They're not going to go to zero. They've demonstrated that they don't want to go down anymore. The issue is when do they go up. That's it.
Okay, very good. We'll have to leave it go at that. Thank you so much, Michael,
for
being with us again.